Morning, market chameleons and soon to appear Dimitri Pargamonic. How you doing, Dima?
Good morning, Will. How are you?
Good, good. You want to start right away with the disclaimer? What do you think?
Yeah, let's start the disclaimer, then get started. So good morning, everyone. Before we get started, keep in mind, Will and I, Market Chameleon, we're not registered investment advisors. We're not broker dealers. We're not telling you what to do. We're just sharing ideas. If you need professional help, call your broker. That's what they're there for, to help guide you, give you, and answer your questions. So there's the disclaimer.
Excellent. What are you seeing this morning?
So let's take a look at what I think I'm going to do today. We'll look at the pre-market report, see what's moving in pre-market hours. Then maybe we'll do an example of value versus growth analysis. Okay, so we're going to take a look at that. We're going to take a look at two stocks. I'll just pick two stocks and look at, well, which one do we think is better? Which one do we think the odds are better, going forward? So we're going to take a look at value versus growth. How's that sound?
Very cool.
All right, so let's start out with pre-market. We got stocks that are trading in pre-market hours, the most active stocks, biggest percentage gainers, biggest percentage decliners. Let's take a look first to see what's going on in the higher market cap stocks. So I'm going to use this filter, stocks 20 billion market cap or higher, see what's moving. So just to take a look at the number of stocks on each list, we got 20 that made the percentage gainers list, 65 on the percentage decliners list. From that perspective, looks more like a bearish bias at the open. Couple stocks here at the top. ACN looks like they're reacting to earnings, up 5.2%, trading 20,000 shares in the pre-market hours. Next one down, PPL, up 3.5% in the pre-market hours. Just hovering over the headline news here. Looks like maybe they sold a unit there or something. But that's up 3.5% in pre-market hours, 44,000 shares trading hands. As you could see, nothing else really sticks out there, kind of, smaller percentage gainers with small volume in the pre-market. I'm going to use the unfiltered report real quick. And a couple stocks jumping up, UPST up 39.5%, trading 157,000 shares in the pre-market hours. Looks like that's reacting to an earnings announcement. TKAT up 28.7%. That's trading 2.6 million shares. That's a $254 million market cap stock, so lower market cap stock. I'm just hovering over here over the headline news. I'm not going to get deeper into it, but it's not obvious what it is, just reading the headlines. Sino up 27.2%. That's trading 2.1 million shares in the pre-market hours. Again, this is also lower cap stock. Looks like that's also reacting to some news in the morning. But to save time, unless you have questions, Will, I'm going to just try to go through some examples of fundamental analysis, value versus growth. So if you don't have anything in the pre-market, any questions in the pre-market hours, I'm going to move on.
Sounds good.
For any other questions. All right. So I'm going to take a look at, the debate, is growth being undervalued right now? Are value stocks being undervalued right now? And what does that mean? How do we quantify those? So we need to take a few examples here and go through the numbers and take a look and just try to make an assessment here. So a growth stock would be one that's very popular right now is Tesla, right? So let's go to Tesla, and I'm going to start out with this stock and then show you a value stock as a comparison. So Tesla, we see here, I'm going to go here to the fundamental summary. And these are right now Tesla's profit margins. And we could see here that, their gross margins, 21%, which is below the rest of the market, 32%, right? Net margins, they're 2% versus rest of the market, 8% in SPY. You can see operating margins below the rest of the market. Same thing with earnings before interest, taxes, EBITDA, depreciation, and amortization, right? 13% versus SPY 18%. So we'll take a look. They're probably take the idea there as well. They're not making big margins because they're using that money to grow their revenues, grow their customers. So they're sacrificing the profit margins for growth because they see bigger growth opportunities. So let's take a look at the growth. So we see here, Tesla, you know, if we took a look at its history, it's growing much faster than the rest of the market, 28% last year versus SPY, down 1%, which is pretty good considering we're in that coronavirus economy and Tesla's not really like a stay-at-home, right, product. 3-year average, they grew 39% per year, year over year, versus S&P 500, 5%. 5-year average, 51% year over year, 4% for the S&P. So we see that on the top line, their revenue has been growing, and they have been executing on that front. So we're looking at a growth play, right? Not profit margins, but a growth play. And eventually what the idea is, they'll concentrate more on their margins. Excuse me. Valuation, we could see here on a valuation basis, way higher than the rest of the market. So people are rewarding them for growth right now. It's a price to sales, price to PE ratios. This is how they look. Price to book value, way above, way above the market. And we could see here that even from a historical perspective, even price to sales, which is taking their market cap, dividing them by their revenue. If we took Tesla versus all the holdings in the S&P 500, Tesla 24.1 versus SPY 3, that's almost a 700% premium to the market. And you could see that has increased from historical levels. All right, same thing down here, price to EBITDA. Everything's increasing versus historical levels. In other words, right now, people are feeling even more optimistic about Tesla than before, about their future. And there's definitely, something behind it because we've seen them growing. We've seen them being successful with new products. Let's see how they generate their yield. So if we just took how much so far they're generating profits versus their market cap, so you could see here, S&P 500, 2.5% yield versus Tesla, almost 0.1%. Operating yield, 0.3% versus SPY 3.6, EBITDA 0.6 versus SPY 5.4. So all right now, everything here is based on their valuations based on growth. So let's just take a look at that. How much do they need to grow? How much are they pricing in Tesla? And then we'll compare it to a value stock. So let me know if there are any questions here, but so far I just wanted to basically demonstrate that this is the play right now, revenue growth and not profit margins for now. Let's take a look first at its fair value estimates, and we're going to look at two different models. This one's looking at its historical multiples versus current multiples. So if we took Tesla and we said, well, historically, the PE, we can't use the PE ratio. It's not been stable. It's all over the place. So we'll go down to the next multiple, which is price to sales. 3-year average price to sales, 6.9. If we use that as our benchmark, this is the implied value in Tesla. Price to book ratio, 3-year average 12.7. If we use that as our benchmark, that's where the implied value of Tesla. Let's see how it compares to the rest of the market. So we see here price to sales ratio. Currently, the price to sales ratio in Tesla 23.2 versus SPY 2.9. That's a 700% premium. 3-year average, it's 181% premium. If we use that as our benchmark, that's the implied value. If we took the average of all these, 244.70, market 701, so 186% premium using those historical benchmarks, its own historical benchmarks. What about if we went forward and said, okay, what if we give it, you know, a boost in earnings and in revenue? You know, forward looking, how does it compare to the rest of the market? So let's use this over here. And let me first come down to the model here and take a look. So what we're doing is saying, well, if we use our benchmark, forward-looking benchmark in the S&P 500, and we compared it to a stock, how do those two compare? All right, so I'll show you what I mean here. So we need the 3 basic inputs we're going to use is the following. We're going to see what do we estimate the next 5 years the operating margins, and we're using operating margins because, and not net margins, because net margins will include any type of earnings the companies make, including outside their core business. So if they made investments in Bitcoins or in the stock market or in bonds, you know, those earnings will count in their total earnings. But what we're interested in is how much are they earning from their core business, right? Because that's what we're looking at, their core business. So Tesla's core business would include something like selling cars, right? It would exclude their investments in Bitcoins, because obviously you could make, if that's what you're interested, you could make those investments yourself. You want to see their operating profits from their core business. So by default, we have here historical reference points, and by default, we're just using their historical numbers and seeing how does that look if those historical numbers persist. So let's first look at that, and then we'll start changing the numbers around. So in Tesla, their current operating margins, 6%. In other words, for every $1 in sales they have in their core business, like a car or whatever else they're selling, you know, solar panels, for every $1 in sales, after they deduct the cost of those goods sold, the salaries for that business, the marketing, research, development, when they deduct all that, 6 cents remains as profit. Okay, that's their operating margin versus S&P 500 as a whole, 11.5%. So that's what we have here. Revenue growth. Well, in the last 3 years, Tesla, on average, year over year, grew 38.9%. We're using the 3-year average as our benchmark, default benchmark. SPY 4.3%. Okay, and the next input we're using is volatility, which is, you know, the risk of the assets. So if you think of two assets, if they yield exactly the same amount, let's say you bought one asset that is 100,000 yielding $10,000 a year, that's 10%, and another asset 100,000 yielding 10%. They're yielding the same thing, but if one asset on a downturn goes, if the market falls on average falls 5%, another asset falls by 10%, it's not exactly equivalent, right? Because for each unit of risk, you're getting less money in asset B than in asset A. Does that make sense to everybody? Hopefully, let me know.
Let us know if you have any questions, chameleons. D's always good to answer them. Looks good.
All right, so let's just see how this looks, and then I'm going to start changing these numbers around, and then I'm going to go to like a value one, and then if we have time, we'll set up like a option strategy around it. So calculations. So this is, if we put that in our calculator, this is what it looks like. That Market cap of all the holdings in SPY, 36.7 trillion. Tesla, 673 billion. Revenue, if we took the total revenue, trailing 12 months in S&P 500 holdings, 12.1 trillion. Tesla, 31.5 billion. So let's look at 5-year estimates using those parameters. If we said SPY grows at 4.3% per year, every year, this is the revenue. Next year one, 12.7, year 2, year 3, that's SPY. If 11.5% operating profit from that revenue, 1.5 trillion first year, this is rounded, 1.5 year 2, 1.6. So after 5 years in operating profits, S&P 500 estimates 7.9 trillion. Okay, so if it's 7.9 trillion in operating profits in 5 years, and if we bought all the stocks in the S&P 500 and it cost us 36.7 trillion, today, 5 years later, we earned 7.9 trillion in accumulated profits. That's a 21.6% return. What about Tesla? Well, Tesla is growing faster in revenue, right? So starting point, year 1, 43.8 billion, grows another 38.9% to 60.9 billion. So you can see here every year for next 5 years, if we give it 38.9% growth rate, if we assume 6% profit margin, this is year 1 operating profits, year 2, year 3, 5-year cumulative profits, 28.2 billion. So if we went out and just bought Tesla, all the shares and owned the company, $673 billion, and we got $28.2 billion back in 5 years, that's a 4.2% return, right? So in other words, you could see here right now, if we just use those estimates, by those standards, if these persist, then it doesn't look such a good do. Let's not go right now to the volatility. Let's just stay with this. So to make it equivalent, to make Tesla equivalent to a 21.6% return, well, where should the stock be? Let's say these numbers do persist. If they persist and we think Tesla should be priced like the rest of the risk assets, right, just in the market, then that would be the implied value. That's if those numbers persist. But let's say Tesla is growing, they're opening up plants, they're getting into new businesses. And, if you listen to the people who advocate for Tesla, they're saying, well, these numbers are still way underestimated, that it's going to grow by more than 38.9%. So some people are saying 80%, right? So 80% growth in revenue year over year, every year for next 5 years. They're saying that the current profit margins are way too low. You got to use their growth margin. So I'm just going to use what the advocates are saying. They're saying 20%. So look, we're giving it to them now. They haven't done this yet. We're just giving it to them looking forward, right? 20% operating margins, revenue growth, 80%. I'm going to recalculate that. If we use those, then you could see that's what people are saying. Then it's really 1,223, 42% discount. So this is now look, these are all estimates. You have to go read about those industries, read about the potential, the potential in these industries. Can they grow it that much? Can they grow their operating margins this much? Go and the advocates, they're putting out their research there. So you could go read them and say, yes, I'm giving them 80%. Yes, I'm giving them this 20% because it makes sense. So far, if we just stick with the historicals, we haven't seen those yet. Okay, so they still have to kind of achieve this, and maybe they can, but this is if we believe in this, then it's a 42% discount. Okay, to the rest of the market. Let's say they can't achieve it, but we do give it, let's say we give it a 50% growth. So I'm just click here. If they grow 50%, which is their 5-year average, and if I give it a 10% operating margin, let's say, not quite as much as 20%, 10%, I'm going to recalculate that. So there, we didn't quite make it to the current valuation. Again, you're playing with these numbers. You're trying to figure out like how realistic is this compared to how realistic are these numbers. All right. So let's go. Let me jump now to something of value, not growth, but value, and see how those are priced. Are there any questions on this?
Seems good right now. Everyone seems to be getting it.
Okay, so let's do like AT&T, like a more established company, right? So AT&T, before we get into the fair value, let me just compare it to you. Here's AT&T. So profit margins here in AT&T are much higher. Look, S&P 500, 32%. Gross margins in AT&T, 53%. Net margins last year didn't do so well, 8% versus negative 3%. But if we just look at the operating margins, remember the profits from their core business, 15% in AT&T, SPY 12%. Okay. In EBITDA, earnings before interest, taxes, depreciation, amortization, AT&T profit margins better than the rest of the market. So as far as their profit margins, those look good. The value looks good, versus S&P. And I picked AT&T because it's a larger market cap stock. They do have longer term contracts. They sell subscriptions. I feel like there's a little bit of a moat around like AT&T and Verizon because they have this infrastructure in place that's hard to replicate. So let's take a look just in AT&T, and I think Verizon's probably, I looked at it, similar situation. But the growth rates here, as you could see, compared to S&P 500, 3-year, not 2% versus S&P 500, 5%. 5-year, 3% versus S&P 500, 4%. Net income kind of dropped here. Operating income, not, their growth, not so good, right? So the growth rates aren't there like in Tesla. That's not as exciting. So AT&T is like a turtle, right? They just kind of, pluck away. And there is some cases, if you read about Verizon, AT&T potential with the 5G, they could benefit, right, from the 5G. They do have, also a lot of data on their customers that, that they might be able to also convert. But
hey, D,
yeah,
we are getting a couple questions. Our man on the ground in Chicago, Mr. Black, is asking, is this tab actually available? I know
actually this summary tab, I think is still internal, but this will be available I think by the end of this week, by Friday. Great. So I'm still working something, but this will be available.
Now Pavel is asking something which I don't think we have. He wants, you were showing the premiums and the discounts to the fair value that we've created. He's wondering if you can screen the entire S&P 500 for which stocks are, the premiums the highest and which stocks it's
right now you can't, because this fair value, these are all relatively new features that we're talking about. That's why I'm kind of focusing on them more. But until we, the model is not fully complete yet. So I'm putting in, inputs slowly, trying to go as I'm putting them in, trying to go over them so they make sense. But the model will still be a little bit more developed than it is right now. So before we go into the screener, it would have to be more developed than it is today.
Very cool. I know I've seen emails back and forth with Jake. He's given you some insights as well into things he sees. So
yeah, exactly. So these are all very relatively new feature, and it's also we're a lot of the data here we're getting from vendors that we're also looking at, and sometimes there could be a data issue. We have to go back with them. Sometimes maybe, we didn't reference something correct. So that could still happen, even though we're trying to work all that out. But, there's a lot of data flowing in here between vendors and us, and we're processing them. So I'm still going through all that as well, especially like foreign-based stocks are the hardest. Or new growth stocks, they're the hardest. But let's look at the fair value really quickly because we're running out of time. So AT&T here, if we did the same thing and used their historical multiples, right? The price to sales, price to book, operating margins. So if we use the historical multiples, took the average 33.6, today the stock 30.15, so there slight discount 10.3%. Somewhere in range, and we could see it's been as high as $34 this year. So that's the implied value using its historical multiples. But let's take a look at forward looking. So here, if we just used, right, as our reference points, if we just use its current operating margins, 15% versus SPY 11.5%, its 3-year growth, 2.3% on average, SPY 4.3. I'm going to skip this volatility for now because we don't have time, but I'm going to get to it. So if we use that, let's take a look at what happens here. So SPY, same thing as before, because I didn't change those parameters. 7.9 trillion in 5-year profits, market cap 36.7. That's a 21.6% return from your operating profits. AT&T, same 5 years. We use 2.3% revenue growth year over year, 15% operating margins. Then those add up to 137.9 billion. Today, the market cap of AT&T 215.2 billion. That's a 64% return. Like if you just bought all their stock and all these numbers persisted for the next 5 years, 64% in 5-year return versus all the S&P 500. So remember, this isn't growth, right? Because we're not giving it a big revenue growth here. We're just saying if its history persists. So what would AT&T, if we just said if AT&T was market cap valuation was priced where the rest of the market, right, would be priced to achieve this 21.6% return, where would it be priced equivalent? And that would be 89.59. So you could see here, we're looking at value, right? Value versus, remember, growth in Tesla. So really quickly, let's just assume, right? And I'm not saying this is going to happen, right? I don't know what's going to happen tomorrow, 1 year, or 5 years from now. All these are just estimates. All these are just right now guesses. I'm just making guesses based on data that I'm looking at. So let's just say, well, this is way too, maybe this is way too high, maybe way too optimistic, but maybe, 34 is a better target. So I'm going to show you, and it'll take a while. Let's say it'll take us a while to get to 34. So I'm going to go here to a leap really quickly. And I'm going to say this has 466 business days left. So 2 years, right? A 2-year horizon. And I'm going to use a target price, $37. So watch, I'm going to sell this at 37. And I'm going to buy 25 call. And I'm not telling you to do this, guys. Please don't say, oh, Dimitri told me. I'm just showing a demonstration. Okay, so this is just a demonstration of a call spread and what it looks like. So if we buy the 25 call, sell the 37 call, this is what the payout diagram would look like at expiration 2 years. So let's say we had 2-year horizon, we're willing to sit there and wait for 2 years for it to go to 37 because we think it's already worth more than that, you know? So the market needs to just pay attention. So if it costs us 446 today, and we're right in 2 years and it's above 37 at expiration, that's a $754 profit, right? So if you're paying, let's say you could get it somewhere midpoint 434, $754, that's what percent return is that? Over 150%?
Pretty good.
150% return. And we're not looking at unrealistic, right? We're not, you know, we could go down to 35. What if it just sits here? What if we're exactly at the same place? Well, then this spread where, you know, there's 37 call will be worthless. This 25 call will be worth $5 or $5.15. Let's just say closed here, right? Because the $25, we exercise the 25 call, right? So we buy for $25, sell the stock 30.15. That's $5.15. If we get it for 434, that's still, I don't know what is in my head, roughly 20% in 2 years. So that's just if it just stands here. So all I'm just showing
is you can win 2 out of 3 ways. You can win if it sits still, you can win if it goes up, and you'll lose if it breaks that strike.
And the demonstration is just if you believe in like the value, the value, and it'll take longer, and you know, but these are options. You're using leverage, right? And you're waiting 2 years. You're giving yourself a while for this to pan out, right? And you could see here that how the payouts work, that it's still, that's just demonstrating leverage in the call spread. And this call spread, obviously market tanks, everything goes down, you know, that's what you paid for it. So it goes below that 25 strike, you know, you lose what you paid for it if that's where it ends up. But at least there you could reassess, should I still be buying it at a lower price or move on? So I'm just showing one demonstration, value with growth. Even in a value situation, there's a way to structure it to still potentially make a good return, you know, with patience. And obviously, I don't know, again, I don't know where this stock AT&T is going, and I'm not telling you to do this. I'm just demonstrating because nobody knows where anything is going to be tomorrow until tomorrow happens, or anything. Nobody knows what's going to happen in a year from now until it happens a year from now. We're just using our data as guidance.
Awesome job, Dima. Great example and another great show.
Thanks, sir. Oh, we went after 9:30. So
yeah, 9:32, buddy.
We're joining. Hope you guys have a great trading day. Stay safe out there. Hope to see you guys tomorrow.
Trade in peace, community.